Hello out there, everybody in the intermediate accounting family. Welcome back. I hope you're doing well wherever you might be. Today in our video, we're going to be taking a look at the Statement of Shareholders Equity. You probably remember there's a lot of financial statements. They all have their own unique purpose. Our goal today is to figure out what the purpose of the Statement of Shareholders Equity is, figure out what it looks like, and hopefully by the end, you'll be able to make your own Statement of Shareholders Equity for our homework problem set. So let's jump right into it. Now, our Statement of Shareholders Equity is going to be a required financial statement. And when I say required, I mean required by GAAP. And we can get the ruling straight from the horse's mouth right here. I've got the FASB codification up, our GAAP codification. You can see in 205-10-45-1A, it stipulates a full set of financial statements for a period shall have all of the following: a financial position at the end of the period. Whoa, wait a second. What the heck is that? It's a balance sheet. That's a fancy way of saying a balance sheet. You know about that already. The next one, an earnings for the period statement, an income statement, a statement of comprehensive income, a cash flow statement, and then finally, what we're tackling today, a statement of shareholders' equity. But it doesn't say that. It calls it investments by and distributions to owners during the period. So let's break that down. When you think about investments from and distributions to owners of the company, what accounts are in play here? Give that a thought. Pause the video for a second. Think about it. What accounts are we talking about when we talk about investments from and distributions to owners? Maybe jot a list down and think of every account that comes to mind. Maybe you can't think of any and you'll just pause the video and sit there and stare at your desk for a few seconds. I'm not sure. Either way, give it a try. We'll come back and we'll share a few of those accounts with you. Okay, so hopefully you've had a moment to consider the accounts that are going to be affected by an investment from an owner or a distribution to an owner in our accounting system here. So, first of all, common stock, right? When an owner invests into a corporation, usually they get common stock as evidence of that investment. Dividends, when we make a distribution to the owners, usually it's in the form of a dividend. We normally think of a cash dividend. We'll learn later on that a dividend can also be property. Paid-in capital, additional paid-in capital, kind of goes along with common stock. We'll learn more about that account. And then treasury stock, when a company buys back its own stock. Right now, you're probably pretty familiar with common stock and dividends. We've studied those both quite a bit. Paid-in capital and treasury stock, you may not be too familiar with those yet, but I promise you, hang with me, and we'll get you taken care of on those as well. That Statement of Shareholders Equity, what's on it? It's going to report investments by and distributions to the shareholders during the period. So we got a period statement here, not a date and time like the balance sheet, but we're looking at the entire accounting period, whether it be a quarter or a year. It's also going to show our changes in retained earnings from the beginning of the year to the end of the year. You know, there's certain transactions that are going to impact retained earnings. When we make net income, when we have dividends we've declared, that's going to change our retained earnings. Your Statement of Shareholders Equity is going to capture and list out all those changes in retained earnings. That mysterious accumulated other comprehensive income, it's going to summarize that. And then finally, it's going to show you that ending equity balance. Why is that important? Because it's going to tie back to your balance sheet. That ending equity balance on your balance sheet comes directly from your Statement of Shareholders Equity. So here we go. Nike Incorporated, big Nike here. Statement of Shareholders Equity. Couple of things to notice right off the bat as we're looking at our statement here. You'll notice along the top, they have the different components listed out. Common stock. They have two classes, Class A and Class B. Normally what happens when a company has multiple classes of common stock, one will have voting rights, the other one won't. We have capital in excess of stated value, or paid-in capital in excess of par, sometimes stated as. There's that accumulated other comprehensive income and retained earnings. You'll notice it says deficit. Nike doesn't really have this problem, but some companies, they aren't profitable. And so instead of having retained earnings, they'll have a retained deficit. And retained earnings will show up as a negative. And then you got the totals there. So our components are listed on the top. We have contributed capital and earned capital. And then down along the left, you see all the different things that happened, broken down by year. There's 2019 to 2020, 2020 to 2021, 2021 to 2022. And so just kind of focus down here at the bottom, since that's really our most recent year. You can see they bought back some of their common stock. Treasury stock. So that's taking away from the amount of shares that are out there and also taking away from that capital in excess of stated value. You see they paid dividends. That's a hit to their retained earnings. And then there's their net income that adds to retained earnings. And you can see they've calculated the new balances for every category, and we get total shareholders' equity of $15.2 billion. As I promised you, that ties into your balance sheet, right? Here's the balance sheet for Nike. Shareholders' equity, total shareholders' equity, $15.2 billion, ties right in. Retained earnings, ties right in. Accumulated other comprehensive income, ties right in. So that's the game we're playing. It's a long statement. It has a lot going on. The goal of that statement is to show a reader how everything in equity changed during the year. Let's look at another one. How about Apple Incorporated? The exact same information, but they've got it flip-flopped. And what I mean by that, if you look at the Nike statement, see how Nike has their dates along the left and the categories along the top? Apple has their dates along the top and the categories along the left-hand side here. Honestly, the Apple statement is a little bit easier to read, isn't it? I mean, you kind of take a look here. There's the common stock, beginning balance, what they issued. You have some share-based compensation here, which can also be stock issued. You can kind of see they got their ending balance, retained earnings. They got their beginning balance, the net income, subtract out the dividends they declared, subtract out the stock they bought back, then they've got the ending balance. We'll talk more about treasury stock and that stock buyback in a few chapters. And then they got their other comprehensive income right there. Beginning equity balance, ending equity balance. Very straightforward. Your book, the example they give is even more straightforward than that. It's just got like 4 lines in it. So very simple, straightforward example from your book. But your takeaway here, you need to know what the Statement of Shareholders Equity is. You need to be able to read a little bit, and you'll need to be able to put together an example kind of like what you're looking at right there. A few helpful hints when you're working on your homework. First of all, I mentioned stated value on the Nike statement we looked at. You'll also see par value. Par value is just simply a made-up number that they put to kind of serve as the default value for stock. And it's a relic from the old days of accounting that we kind of still carry to this day. In the old days, it was supposedly the minimum amount of capital that an investor should be contributing to a company. And they kind of put that law or put that rule in place, so companies just started kind of finagling the law a little bit and just making the par value extremely small, like Disney stock here. The par value is a penny. Okay, so it's just kind of a pain in the butt now to do the accounting for, and it doesn't really have a lot of bearing except for on our accounting entries here. But to tell you what par value is, just kind of the value, it's an arbitrary number assigned to the stock to serve as the base value, I guess you could say, of that share of stock. So assume I bought 1 share of Disney for a penny, okay, the par value. But I paid $100. I bought 1 share 1 cent par value, but I paid $100 to Disney on the IPO when they sold it. Disney would debit cash $100, and then they would credit that common stock account 1 penny. And the remainder of my $100 would go to additional paid-in capital. Or like we saw with Nike, they don't call it par value, they call it stated value, additional paid-in capital beyond stated value. I can't exactly remember how they phrased it. Capital in excess of stated value. Okay, same idea. So additional paid-in capital, capital in excess of stated value, exact same idea. And the idea being it's the amount over par value. Okay, so kind of keep that in mind in your homework, because you kind of have to break that down for the money that your company receives for their stock. You have to break it between the actual par value and then the additional paid-in capital. If you look at it from a balance sheet standpoint, or you look at it on the Statement of Shareholders Equity, it's kind of funny. Here's an example where the company has 1 cent par value. You'll notice a really small number. 5 million here. They don't even have a number here because it's just a rounding error. So few shares issued that it doesn't even round up to 1. All that big money is an additional paid-in capital. So really, these two numbers together represent the amount that the shareholder invested when they bought the stock. Just split into two different numbers. The par value of the stock that was issued, and then all the money invested above and beyond the par value. So like I said, it doesn't really have a big bearing. Both these amounts end up in equity under stockholders' equity. It just makes the bookkeeping a pain in the butt because we have to separate it. And usually the separation is so stupidly small that it would be just as good to lump it together and be done with it. But we separate it. A couple more helpful hints for your problems. Dividends, whether we're talking about dividends on common stock or preferred stock, are paid on whatever shares are outstanding at the time the dividend is declared. Okay? So if we had 1,000 shares of stock and we issued 500 more, 1,500 total, and then declared a dividend, that dividend would be paid on the 1,500 shares. Treasury stock is when a company buys back its own stock. That's going to reduce the number of shares eligible for dividends. And so my 1,500 example, let's say I bought back 750 and then declared a dividend. Well, that dividend's only going to be paid to the 750 shares that remain outstanding. Keep that in mind for your homework, and hopefully things will go smoothly. Hey, that's it for our chapter. We did the balance sheet, we did the Statement of Shareholders Equity, and now it's time to do our problem set and knock that out. Looking ahead, we'll be jumping into the income statement and the statement of cash flows, and by then, you will be an expert on the 5 required financial statements. Hope to see you back here for those videos. Good luck on your homework. If you need anything, don't hesitate to reach out. See you next time.